This is Gonzalo Garcia at Agency One. We are going to talk about Nationwide CareMatters Together, which is a brand new product. Want to introduce our speaker today, Shawn Britt, who's a CLU and CLTC, has been engaged in the life insurance and long-term care industry since 1995. She joined Nationwide in 2000 and has been a member of the advanced sales team since 2005. She's been a major influencer in the development and promotion of Nationwide's suite of long-term care product solutions. We've had her speak at our meeting and on webinars in the past. Shawn, it's always great to see you join us, and thank you for your expertise. Welcome, everybody. Shawn, the screen is the show is yours. Thank you.
Thank you, Gonzalo, and thank you all for joining us. It's always a pleasure to do meetings with your group. And I think the last time I saw you all in person was probably right before COVID. So, and though I'm not seeing you, it's glad to be back with you. And I have a lot to talk about in this hour. So I am going to show you our new product, CareMatters Together. And then I'm going to touch on how to discern when CareMatters Together is better or CareMatters 2 policies are better. I know it gets a little, we have CareMatters 2 and CareMatters Together. So CareMatters 2 is our individual product. And there are times when you might want to buy 2 of those instead of a CareMatters Together. So we'll talk about that. And then I'm going to touch a little bit on how to use this in business settings. And if we have time, the number one question I get is,
we're going to share all brochures, consumer
is in regards to divorce. So I'm going to talk a little bit about that as well. So we'll go ahead and get started. And I'm not going to go through this agenda, but again, we have a lot to do. So long-term care, I like to remind people that your clients think of it as a place. They think of long-term care, and the first thing they think of is a nursing home. And I think it helps when you're having that discussion. They go, I don't want nursing home insurance. For you to be able to say, you're thinking about a place. This is not insurance for a place. This is insuring your retirement plan. And if you don't have this in place, it could unravel everything we've done to make sure that you have a secure retirement. And what it's going to do is give you choices. In fact, the chances are very slim you'll end up in a nursing home. But if you have long-term care coverage, you're going to have all the choices that you could dream of, especially if it's a cash product. And, people have different ideas about how to pay for long-term care. They think, oh, my daughter will take care of me. Well, okay, that's well and good. But first of all, does she know that? She may not. Number 2, even if she's willing to do it, what is the cost to her? Family care is not free, ever. It costs somebody, and it could be the potential loss of their health, their well-being, their earning ability, their relationships with their spouse, spending time with their children. There is a cost to that. Income is a dollar for dollar expenditure. They'll tell you they can self-insure. It's really self-funding. And when it comes down to self-funding, if the market is up, do they really want to take money out of the market? And if the market is down, they really don't want to take money out, because money that's been removed in a down market is money that won't grow back or grow forward. And they don't think through it that way. So I like to think of insurance not only as a cost-efficient way to leverage a benefit amount, but it's really insurance on the portfolio. If you have long-term care insurance, you've got a guaranteed amount of money off to the side, not tied to the market, that's ready at a moment's notice. It's pre-leveraged, and then your portfolio can just ride the ups and downs of the market without you interrupting anything by taking an abrupt withdrawals for a major long-term care event. I think you all know this stuff. I'm not going to go through it because I have a lot to talk through. But I mean, basically, it secures any financial goals that you have, whether it's taking care of your grandchildren's college, leaving money to your university, making sure your spouse can continue to live the life that they're used to living. Now, why is a linked benefit policy a good idea? Well, if you think about it, it's got several advantages. And one of them is that it offers guaranteed premiums. So all linked benefit policies have guaranteed premiums. You don't have to worry about a price increase. It doesn't happen. Once you've bought the policy, you are locked in. And then the death benefit and the LTC benefits are also guaranteed. And you get a death benefit if the insured doesn't use their LTC benefit. So it's like you're not losing all the money that you put into the policy. More importantly, it provides that immediate leverage I just talked about, a guaranteed pool off to the side, ready to go at a moment's notice. So how does our new product CareMatters Together work, and why is it different? Well, one, it's the first cash indemnity joint life linked benefit solution in the market. And it's a more cost-effective, in most cases, I will tell you, there are a few places where it's not, but in most of the time, it's going to be a more cost-effective solution when you've got two people wanting to buy a policy. So this policy is going to offer simplicity, predictability, and more control. And we're going to go over that. So how does it work? Well, it's more simple because you just simply choose benefit payments. You don't have to decide how much each person might need. You just pick one lump of benefit payments. In fact, we don't refer to them in years. We call them monthly benefit payments. So if you were to buy CareMatters 2 or individual product, you'd be picking from, a 4-year, a 6-year, a 7-year benefit, whatever. With this one, you're picking benefit payments. How many benefit payments do you want? It's a shared pool. So it just allows you just buy one chunk of benefit payments, and then as life takes its course, you decide how to use the benefit payments. And you can split those payments up any way you want to. And so I'm going to show you 3 examples of that. I'm also going to, at the same time, I'm going to explain our waiver of premium. So with this product, if you're on claim, the entire premium is waived, the whole thing waived. So in this case, Monroe goes on claim, and he's on claim for 24 payments, monthly payments. During those 2 years, he's using those 24 payments. No premium has to be paid. It is waived, the whole thing. Now, at the end of 2 years, Monroe passes away. So at that point, then his wife, Dolores, would have to start making payments. They would make premium payments again if they were in a premium payment mode. If it's paid up, it isn't a concern. But if they haven't paid it up, then she would resume premium payments. 2 years after that, she goes on claim. Now, if she's still in a premium payment mode, she stops premiums. They are now waived. She has 72 payments left that she can use. Now, our second scenario is where we have an overlapping claim. So in this case, Stephen goes on claim. And so if they're in a premium payment mode, still premiums are waived. 2 years into his claim, his spouse partner, Michael, needs to go on claim. And so then Michael goes on claim, and about 3.5 years into Stephen's claim, he passes away. But because Michael is still on claim, premiums are still waived. And so he would have a total of 54 payments because Stephen has used 42. So they had a 96 payment policy, and that's how they used it. Now, here's a situation where the family decided to let John use the whole thing. And the reason is their daughter decided, Mom, I have the ability to take care of you, but I don't have the strength to take care of Dad, and neither do you. So Lori was still in pretty good shape. And so as a family, they decided to spend the money all on John, all 96 payments. Now, I'm going to say this is a very unusual situation. This is very unlikely to happen. there's about a 5% chance of a claim going beyond 5 or 6 years. About 15% chance going on be 5% chance going beyond 6 years. So for someone to use 96 payments would be very, very tiny chance, less than 5%. But we like to show it to show you that one person could use them all, because that was a question we were getting a lot. Could one person use the whole thing? You get to choose whatever you want. This is your policy, and you get to choose how the two people use the policy. So you have guaranteed premium, guaranteed long-term care benefits, guaranteed death benefit, and we have a paid up reduced policy. So the compliant way to say that is guaranteed accumulated LTC benefits if the premium payments ever stop. So what does that mean? Let's say you have a pay to 100. Actually, I'm going to say the 20 pay. That's a little easier. You have the 20 pay. After 10 payments, you hit on some hard financial times. You've made 10 years of premium payments, and you're like, I can't afford this policy any longer. You can call us up and say, all right, what would I get to retain if I stop premium payments now? Well, you had paid 50% of the premium, so you would have a paid up policy equal to 50% of the issued amount. So this gives people an exit strategy. That's really important when you have clients who say, well, I'm still working now and I can afford this right now, but what happens if something hits I wasn't expected in retirement when I'm on a fixed income? Well, here's your answer. There's an exit strategy. It's called a reduced premium paid up option. So you can capture everything you've already paid for, and premiums stop and everything is still guaranteed. So we have a cash indemnity. Everything at Nationwide is cash indemnity. And basically the difference with cash indemnity is there's no need to submit bills or receipts once you have been approved for your claim. 100% of the benefit is available to you. It is cash. There are no restrictions from Nationwide on how you use the money. A reimbursement plan would require bills and receipts to be submitted by someone, depending which option you choose to do that. And then you have to find out what was covered. Then you get a bill for what wasn't covered, and you pay for those out of pocket. So when you have a cash indemnity policy, there is, as long as the benefit covers everything you're doing, you have no extra out-of-pocket expenses. That's one of the advantages to a cash policy. You can pay for things that aren't considered contractually traditional long-term care expenses. Things that are alternative care services that a reimbursement plan wouldn't cover, you would be able to pay for from your cash indemnity policy. So let's look at our policy features. I'm going to start with the underwriting classes. So we have 4 underwriting classes. We have non-tobacco preferred and tobacco preferred. And then we have non-tobacco standard and tobacco standard. And this is real important. Only one person can be standard. This is different than CareMatters 2. And CareMatters 2, you have to be preferred. So with CareMatters 2, our individual product, everybody's preferred. You're either preferred or you're declined. With this product, we're going an extra 4 tables. So preferred is the first 4 tables. And then standard will go through as low as table H. So this gives more people a chance to get into the product than CareMatters 2. So let's say you have a couple and they, for whatever reason, they decide they're going to buy 2 CareMatters 2 policies. And we find out one of them is a decline. The underwriter should have a pretty good notion if they should know that whether or not that they would qualify for the standard rating on CareMatters Together. And then you could change over to CareMatters Together if you wanted to do that, to make sure that you had both insureds covered. Gonzalo, did you have a question?
I did. We have a question,
Sure.
Shawn. Knee and hip replacements, are those all declines, or is there an underwriting status for those within the standard or preferred bucket?
Generally, we will allow one. Once you have multiple replacements, it starts getting dicey. But if you've just had one and it's all, it's already done and you have time under your belt, if it's just been freshly done, we might ask you to wait to apply. But as long as you've, it's already done and you've got a history that everything went well, if you've got one replacement, then you have a possibility. But
Okay.
we generally don't take the multiples.
Well, I will be an advocate for you. My wife had double hip replacement and she has a policy with not this one, but a life policy with an LTC rider. So I've lived it myself. I know you guys do that, so that's wonderful.
Yeah.
Thank you.
And you're welcome. And there's always exceptions to the rules depending on whatever else is going on in someone's health. So, we just, one replacement we're comfortable with. When they become multiple, we've got to look at some other things. So I can't make promises. Age ranges, minimum age is 30. And our maximum age depends on how you're paying for it. So if you have a single pay, it's 70, a 5 pay, it's 70, a 10 pay, we will go to 70. But if you're going to do a 20 pay or a pay to 100, you can't be more than 65 years old. And that's because we're not getting enough money fast enough to be able to invest it to, you get the idea. So also we will do a 25-year age difference if both insureds are preferred. If one of them is standard, we will take a 10-year age difference. So where the 25-year one becomes important is if you have an adult child and a parent wanting to go on the policy, we will take parent-child combinations. This is the one combination in which the two insureds do not have to be sharing a residence or a business. I'll give you a couple other combinations that are common, so you kind of get the idea. But as long as the mom is not more than 25 years older than the daughter or the son, or the father and son, whatever combination, then we will allow that. You have your May, December marriages, etc. We will take that. Again, if one of them is standard, then we're down to a 10-year difference. So now we're really talking more about a couple in which someone is, more than the standard 2 or 3 years older than the other. When I was talking about the parent-child, they don't have to live together. But our most common request is sisters. And what they want to do is, like, you'll have a couple of sisters, they're 45 and 47 years old. One of them lives in California, one of them lives in Ohio, but they've always said when their husbands pass away, they're going to live together and take care of each other. And we've had several people calling to see if we can take their clients who were sisters and want to do this. And the answer is not unless they're living together. 45-year-old sisters have no insurable interest. But if they're 65 and 67 and they're already widowed and already living together, then we will take them. So when you have sisters, I've never had a request for brothers, by the way. I guess brothers don't want to live together and take care of each other, but the sisters do. So in those type of situations, they have to be living together. Theoretically, we would take business partners, but if you get a case like that, I would like to discuss it. Honestly, it doesn't make sense most of the time to use CareMatters with business owners. It might for a family business or a few exceptions, but using the long-term care rider with life insurance might be better for business owners. Gonzalo, yes.
Yes, hi. Again, I've got another question. Shawn, is the product available for sale in Maryland and in Virginia? What are the state of, I'm sure you're going to get the state approvals at some point, but just wanted to hit that question real quick.
In Virginia and Maryland, I think we're both good there. We're still, if you live in a compact state, it's approved. There's that handful of states that fall shortly after the compact states, and those are still falling into line and will be approved very quickly. Really, the only two states you have to basically wait for is going to be California and New York.
That answered the next question from Mitch. He's in New York and he asked that question. So California and New York, we're going to wait. Everybody else should be done or done soon. And just for everybody that's on the webinar, we will have somebody asked a question earlier, if we can send out product brochures. We'll make sure we get product information out to everybody on this call. Okay.
Great.
Great. Thank you, Shawn. Sorry for the interruption.
Oh no, anytime, just pop in. I like to answer them along the way. Product limit. So the great thing about this product, one of the things we wanted to do is we want to be able to serve a broader scope of couples. You can get into this product for as little as $1,500 a month benefit. Remember, CareMatters 2, you have to have a $2,500 a month benefit. And if there were two of you wanting to buy, that equals $5,000. You can get into this for $1,500 minimum benefit. So and I'm going to show you shortly the cost of that. Now, if you live in South Dakota, it's $3,100. Vermont has a $2,325 minimum, and Wisconsin $1,860 minimum. But for all the other states, it's $1,500 minimum for your monthly benefit. The maximum we will issue is $20,833. Now, you can still inflate that $20,000. But the issue amount on the day the policies issue can't exceed the $20,833. Our premium payment options are single pay, 5-year, 10-year, 20-year. We got rid of pay to 65 on this product. We made it a 20-year. And then our pay to attained age 100. And that is going to be to the older insured's 100. All of the multi-year premium payments can be annual or monthly. There is no modal factor on annual, so it will not cost you more money if your client wants to pay annually. Same price, whether it's monthly or annually. So they won't pay more for the monthly benefit. And for all payment options, the full premium will be waived while you're on long-term care benefits. Yes.
Shawn, a couple more questions. Would an otherwise healthy 56-year-old male, as an example, with Parkinson's, and a healthy 56-year-old spouse be eligible for standard, assuming the spouse is preferred?
Typical declines. So your Parkinson's, your multiple sclerosis, your type 1 diabetics still declined. Insulin dependent type 1s. Those are still going to, so the obvious declines are still declines. But those borderline people that might otherwise be declines with other products will be opened for acceptance on this one.
Great. Thank you, Shawn.
Oh, you're welcome. We also changed our inflation options a little bit. So we've got the typical 5% compound and 3% compound, but notice we call it for life. And the reason we call it that is we now have a 3% compound for 20 years. What we did was replace 3% simple with 3% compound for 20 years. The pricing is somewhat similar, but the advantage is a lot of people are buying these policies in their late 50s and early 60s. If they can get compound for 20 years, they're about to the age where they would pretty much need long-term care anyway, and it ends up saving them premium dollars. So this is for the older, if you have a client in their early 60s, I would consider doing 3% compound for 20 years to save money. Now, our guaranteed minimum death benefit, that's the residual death benefit, is 10% on this product. Remember, with CareMatters 2, the individual product, it's 20%. This one is 10%. And we did that because it helps with the pricing, and we want to make sure we want to get as many people long-term care coverage as we can. And that's why we lowered the minimum amount, and going to a 10% residual helps us with the pricing to do that. Now, as for tax advantages, it's just like CareMatters 2, the premium is made up of two components. Now, the difference is the life insurance premium is one premium. So it's not split as a his and hers, for example, one life insurance premium. But the LTC rider premium will be split. Now so you're going to see on the illustration, it'll actually tell you what his portion is and what her portion is. This is really important. We had to do this to make sure that it kept all the tax advantages of being tax deductible, either as an individual paying income tax, or to get HSA reimbursements, or for the business cases. So I'm going to show you in a few minutes how that would work. I've got a chart so you can get a visual. So you're going to get all the tax deductions. And because we've split these, each person's age-based limit will apply. So that's very helpful. And I will give you an example in a moment. Yes, Gonzalo.
Okay, we have another question, Shawn. Is the I'm not sure, I'm not 100% sure I understand the question, so I may ask for some clarity. Is the product considered a tax qualified long-term care, or is it a hybrid rider to a life or annuity? If tax qualified, is it partnership qualified?
I understand the question.
You do? I don't.
And okay. There's a misunderstanding about tax qualified. So a lot of people think a tax qualified policy has to be a traditional long-term care policy. It doesn't. You can have a tax qualified rider on a life insurance policy. So what I will tell you, I think what's more important is to be tax qualified, it has to be a 7702B policy, which is what this is. But it is a combination of riders. It has a life insurance foundation. The life insurance foundation is there only to protect the premium from loss if you were to not use the policy. It is possible on CareMatters 2, you always get at least the premiums you paid into the policy. With this one, it is possible that your death benefit could be less depending on your age. If you put 5% compound inflation on it, your death benefit might be less than the premiums paid. But the death benefit on this product is only to protect premium. It's not like life insurance with a long-term care rider that's a combination of family protection in the early years and long-term care protection in the later years. So the answer is yes, it is a tax qualified product because it's 7702B, but it is not a traditional product, which it would have to be partnership compliant. Thank you for that question, because I like to clear that up for folks. So anyway, our elimination period is a 90-day calendar day, retroactive to 0. So here's what that means. While you're going to have a 90-day period in which you don't get any benefits. That'll be during those 90 days, you're getting your claim paperwork in, getting your claim approved, etc. On day 91, you will get paid for month 1, month 2, month 3, and month 4. So you can see there on the 4th month, we're showing $40,000 being sent. This is a policy that would normally pay $10,000 a month, but that first payment will be $40,000. After that, it reverts back to $10,000 a month. This is a way. this is a cost-effective way for the insurance company to give you kind of the equivalent of a zero elimination period, but it helps us price it better. A true zero elimination period is more expensive. By doing it this way, we can save premium dollars for you. Now what I want to do is before I go into my other stuff, just remind you that we are there every step of the way. You get a care manager, and you will keep the same care manager through your entire process. They will walk you through, make sure you want that everybody understands, yes, what you're telling me is wrong with you is a long-term care claim. Let's get started. They're going to help you file the claim. Our care manager will make sure you get a plan of care created that's appropriate for your client. They don't have to depend on their doctor to do a plan of care. Doctors traditionally do not write good ones. They get sent back saying they're not right. That's why we now do it, so that we can get the claim expedited. We will help you find local care services and provide ongoing support as their clients' need change. So we're going to be there all along the way, and you will keep your care manager. So you're not going to have a new one every time you call in, which is good. Now what I want to do is I guess I have to do a new share, and I want to show you. Let's see how that works there. I want to show you about why we would sometimes look at CareMatters 2 versus CareMatters Together. And I'm just going to go to this list, this checklist, and we can make sure you get this. This is a marketing piece that we can make sure you get. So when would you use CareMatters Together? Well, if you have two people who are just unsure how much to purchase for each person, it makes sense to just buy one big pool of funds that you can share. Most of the time, it's going to be more affordable for two people. So it makes sense. Not only can you share the benefit pool, but it'll cost you less. You also have, because it's a shared benefit pool, if you have one policy with one chunk of benefits, when one person passes away, the survivor gets to use all the rest of them up. If you have two individual policies, you don't get to do that. But with CareMatters 2, we might want to use that if, for whatever reason, you want a longer benefit duration for one or both people. And that occasionally happens. And I use the case of my godmother. She had two sisters and a mother who had Alzheimer's. Ironically, she was born from the second husband. Ruthie's first husband died, and she had had two daughters by him. And then she remarried, and she had my godmother, Wanda. So Wanda always hoped she took after her father. And indeed, ultimately she did. But her two sisters and her mother had extended Alzheimer's, and she wanted a policy that paid for a long time. So you will have people like that. If you need a death benefit on the first to pass away, you might want two individual policies. In other words, you need to get the money back on the first death. And there could be reasons for that. For example, you could have a second marriage, and they don't want any death benefit. They don't want the surviving spouse to control who gets the death benefit. They might just want two policies, so he can leave his death benefit to his kids, and she can leave his death benefit to her kids. And that's usually with couples that keep their assets and those type of things separate. So those are some examples. I also want to show you how truly affordable this is. I mean, it's amazing. So I'm going to show you the difference between CareMatters Together and CareMatters 2. So we're going to compare a CareMatters Together 96 monthly payments, which would be the equivalent of 8 years if it was 2 4-year increments, if we split it. The monthly benefit would be $2,500 per insured. which would be a total shared benefit pool of $240,000. And we're going to compare that to two separate 4-year CareMatters policies, each having $2,500 per a month per insured, with a total benefit pool for Mike of $120,000 and Judy for $120,000, which equals the same thing as a shared pool of $240,000. Now, if you look at the premium, annual 10-year premium for the CareMatters Together, it's a little under $5,100. But if you look at the two policies combined, it's almost $7,100. So basically, we're getting a $2,000 a year savings, or over the course of the 10-year premium schedule, a $20,000 savings by using CareMatters Together. They have the same coverage. The only difference is they're paying $2,000 less, and they have a shared benefit pool. Instead of him having 4 years, she has 4 years. If he dies, she doesn't get the other 4 years with CareMatters too. She just gets the money back they put into the policy. But with CareMatters Together, she would get the rest of the benefits he didn't use. So this is a good example between a practical standpoint and a cost standpoint, how CareMatters Together is a much better choice for this couple. Now, I told you one of our goals at Nationwide was to make this more affordable to the masses, and we feel so good about what we've been able to do. So this gives you an idea. And here we have done a policy. Excuse me, I had to take a sip of tea here. And we're going to use, this is 72 monthly. Oh, yes, Gonzalo.
I'm sorry, Shawn.
That's okay.
More questions. Can an individual have a shared benefit rider on the CareMatters too?
We do not do that.
Okay. That's
And
what I thought.
we honestly, we don't like that concept, because you end up losing the death benefit if you don't use I don't know. We personally don't care for the concept. We would rather do that. We think this is a better solution for couples. That's just
Got it.
our feel. We're not saying the other is a bad thing to do. We just like this idea better. So this
Okay.
is what we chose to do. Plus,
Great.
we don't want to cannibalize our, you got to be careful when you have multiple products that you don't cannibalize one. So anyway, this is a 72 payment policy. So it'd be a total of 72 payments. We put 3% compound interest for 20 years on this. This is for a couple. They don't make as much money. They're people that might not have been able to afford CareMatters too, but we can get them into a opening amount of $1,500. And if they don't put any inflation on it and do a pay to 100, it's $86.97 a month. If they pay over 20 years, it's just a little over $109 a month. You may say, well, what good is $1,500? Well, to a middle-class couple who have a limited portfolio, it could be the difference between the portfolio lasting until the survivor passes away or not lasting. I mean, you've all seen how just a little bit extra money in a portfolio or a little bit of extra money not coming out of a portfolio can save it. And that's exactly what this does. This could make the difference between a second spouse surviving on their assets or not surviving. You put 3% compound on it, we can get that after 20 years, we get that benefit up to $2,709, which is even nicer. And the pay to 100 is still, not quite $128 a month. And even over 20 years, $165 a month. This can be affordable to that middle-class couple who could not afford the other products out there. And our pay to 100s compete with the traditional policies. That's the most exciting part to us, is we literally can compete with a traditional shared benefit pool with a traditional policy. And with our policy, you've got that death benefit. And you have guaranteed premiums. You don't have to worry about the risk of the premium going up like a traditional shared care policy. So this is really exciting for us, that we've been able to open this market up to people who don't make as much money as the other products have required people to do. Now I'm going to unshare this. And I am going to go to, please tell me it didn't disappear on me. Hang on. Okay. Okay, can everybody see, Gonzalo, can you see my chart?
Yes, it just came through. Yep, thank you.
Okay, I'm gonna make it big. Give me a second here. All right, so what I wanted to show you here is the age-based limits chart. And this is because our policy can be used, and the CareMatters Together can be used in business situations. So let's say you have a pass-through entity, and he wants to buy a policy for himself and his wife, which he's allowed to do. You can use CareMatters Together. It'll be more cost-effective, and you get to the deduction for both the spouse and the owner on the long-term care premium portion of it. So, for example, let's say you're going to do a 10 pay. She's 58, he's 61. Well, for the first few years, she's going to get that $1,790 deduction. And as it goes up, he will be able to get up to $4,770, or the amount as that goes up when the age-based limits go up. Remember, you get the lesser of the age limit amount or your premium paid, which is ever lesser. So the fact that we've got the LTC premium split out, one, qualifies product for deductions, and two, clarifies what the deduction is. So that helps a lot. Also keep in mind that if you want to do this for employees, so you can do, everything's deduct. There's no age-based limits for employee, the carve-outs and the C corporation owners. So this is a really good thing. But for the individual taxpayer or those pass-through owners, you would just use this chart. The illustration breaks out the premium for each person for a separate identifiable long-term care premium. If you want to use your HSA dollars, it would be the same thing. She's 58, so she could ask for an HSA reimbursement up to $1,700, which is ever lesser, the premium she paid, or the $1,790, and he, being 61, would be able to get the $4,770, or the premium paid, which is ever lesser. Now, he's going to be in that basically the full 10 years. I'll be in that 61 to 70 bracket, but she, after 3 years, is going to pop in. She'll become 61. Then she goes into that next bracket with a much higher deduction. So the beauty of us splitting out the policies is that it is deductible, and we have clarified what needs to be deducted. Finally, before we end the day and open it up for any last questions, and I can't believe nobody's asked it yet. I guess because I said in the beginning I was going to talk about it, but I don't know if Kim is on the call today. Kim, if you're on the call, I'm going to give you a call out here. Several years ago, Kim had asked me if I would write a white paper on how survivorship policies with long-term care could be handled in a divorce. And a week later, a girlfriend of mine who's also in the industry asked me to write a paper. And a week after that, an advisor called. He had a set of attorneys that asked for a white paper on that subject. So I was like, okay, 3 in a row, a week apart. I'm supposed to write this white paper, but Kim started that ball rolling. And so that white paper is available to help, but I did want to let you know, I am finding some situations that white paper doesn't cover when it comes to CareMatters Together. So I am working on a CareMatters Together specific paper. But the number one question I get is, can you split the policy in the event of a divorce? And the answer is no, not because Nationwide doesn't want to, it's because we're not allowed to. So there are regulations tied to long-term care that don't allow the policy to be split. Nobody with the type of policy we have, it can't be split. And I won't bore you with why, but it is a regulatory issue. So we can't split it. But what you can't, and again, the white paper, and anybody who wants the white paper, I'll be glad to make sure I'll send that to Gonzalo, and so he can pass it out and make sure you all get that. And again, when the new one is available, it'll have a little more defined guidance with CareMatters Together. But here's what we can do. We can't split the policy, but the divorcing couple can split the benefits, and Nationwide will recognize a court order. So for example, they get a 96 payment policy and they decide, okay, each of us get 48 payments. And then after the death of the first person, whatever's left of their 48 payments can be used by the survivor. That's going to probably be the typical split. And then they put that in the divorce decree. We get a copy of the divorce decree, and then that will flag that policy on our system. And that means we then will not allow either one, while they're both alive, to collect more than 48 payments, for example. And you can make it any way you want to. Whatever your divorce decree says that fits within the policy parameters, we will recognize and honor the court order. Yes, Gonzalo.
Great. We have one more question so far. How are avocation and aviation risks underwritten and addressed or assessed? I'm sorry.
Aviation restrictions are probably going to be the same as the long-term care rider. So honestly, I don't deal with that on a daily basis. William, are you on the call? Maybe William has something to say on aviation risks.
William, that's okay. Mr.
He might have
Brinkley, we
dropped. I
can,
know he was on earlier.
yeah, William's on, he's on mute. I'm not sure
Okay.
if he can unmute himself. Lisa, if you're there, can you see if you can unmute William, assuming he's got an answer for us? And if not, David.
Yeah, I asked him to unmute.
Okay, that's okay. David, we'll get back to you on that. We'll get you an answer. I'm just going to make a note of that. Thank you for the question. I do have another question, Shawn. Oh, the avocation was scuba diving. And again, David, we will get back to you on that question. So just going to make a note. Go ahead. Shawn, go ahead. I'm sorry.
Oh, okay. Well, so basically, yes, we'll recognize court orders. One thing, Kim and I had a long discussion about this several years ago when we got to spend some time together at a conference. And, ownership can be important with these policies and how you set ownership up. And I also have I have a white paper on that. So it's, you want to make sure that the ownership matches the client's situation, so that if one person is paying for the whole thing, maybe that one person should be the sole owner of the policy. For example, it's a second marriage. He brought all the money in. She brought in nothing but some good looks. And, he might want to own her policy just to make sure he can control everything. On the other hand, if you aren't an owner, keep in mind, there's no guarantee you'll get the benefits. So there's some pluses in mind, because remember, we pay the owner of the policy. If both people own it, both people will have to sign off on a claim. And generally, we will pay the primary the check will go to the primary owner. However, the primary owner can say, send the check to the other owner, for example. So, you know, there are all of that's one of the things that joint policies bring up some of these questions. Another example would be, what happens if you do get a divorce and the premium payments are going to, we'll say the husband, but the wife is on claim? Is that going to create a gifting situation for him? Not if it's in the divorce decree. So again, we've got a court order saying we're supposed to split payments, half for him, half for her. We're paying him because he owns the policy. The court has decreed he has to give her the money, and he's going to give it to her without any gifting because it's part of the divorce settlement. So these are some of the questions that I will answer in the white, and that's already answered in the one white paper and will be answered in the other one as well. If anybody has any other questions they want to ask, go ahead. But hopefully you're excited about this new product. And I know we're getting swarmed with illustration requests.
Yeah.
We've got a ton of applications in the door. We are super excited.
That's great. So we have a couple more questions. Bear with me.
We got time.
This session is being recorded for that person who asked. It's an anonymous attendee. We do have it recorded, and it will be probably posted on our website, and we certainly can send people links to a recording. Quick comment about deduction on joint policy. I believe that was part of this slide. Actually, that's right on the screen. You want to just give a quick summary on that again, Shawn, if you don't mind?
Remember, we have separate identifiable premiums. We have broken out his and hers long-term care premium. So as if it's individual taxpayers, they will use this chart. This is the age-based limits chart, and they can deduct the lesser of the number on the chart for 2023 or the amount of premium they actually paid for the long-term care portion of their policy. It's just one, it's not broken out into 3 chunks like CareMatters 2. It's all added together for you. So you just look at where you are on the chart. That's your deduction. If there's 2 of you and you're in 2 different age brackets, you get yours and he gets his, and that's how it works. So this chart applies whether you're doing HSA reimbursements, individual tax deductions, or tax deductions as self-employment health insurance for a pass-through business owner.
Thank you, Shawn. A couple other quick questions. Compensation grid, same as the CareMatters 2 product. I think that's a question we could probably answer offline unless you know it, Shawn, off the top of your head. No?
Do commission.
Okay.
I don't answer commission.
Shawn doesn't do commission questions.
No.
And there was another question is, when we get the information on the product, will we get the premium slide? We will. So I was going to comment on that. You know, I don't know that there's a premium slide. There are premiums for individual cases. So Jane, you know, feel free to call any one of the folks here in the office to get a quote or illustrations. We are happy to run illustrations on this product for anybody who cares. We're doing a lot of them now. As Shawn said, we're getting a lot of inquiries on this product as well. It's a brand new product, and it is a unique product. There's no other like it in the marketplace. So we're really excited that Nationwide has come out with something like this, and certainly kind of making it more accessible and more available to a broader market is really, really important. If you have any additional questions, please put them in the Q&A box. I'll give it another second or two, and if not, we will thank Shawn for her incredible information and knowledge. And Shawn, you're always so much fun to do these with. Hold on, I got another question. Can you send us full slides? David, we will send everybody the slides and a link to the recording and some additional product information that is available, some brochures and so on that Nationwide has put together. So anybody that was on this webinar will get those, and we will also be pushing out more marketing material on it.
I'll send Gonzalo the 2 divorce papers.
Great.
One is about ownership. That's actually the one Kim asked me to write.
Right.
And then the other one is more of a technical, what do you do if you get divorced? What's gifting? What isn't gifting? But when you have those unusual couples and you're a little concerned, how do I make sure I set this up in the best way possible? That will help you.
That's great. And Shawn, you're always available on the phone and you've always made yourself available. So we're very grateful for that.
Absolutely. And if you get those business cases, let's look at those to make sure that CareMatters Together is a good fit.
Yep.
Because our other product might be the better fit.
Got it.
Our survivorship on SIUL could be the better fit, or just doing 2 CareMatters 2 policies or whatever. Yeah.
Great.
We got to be careful with the business owners. We'll take them, but they don't always make sense.
Sure. Shawn, I don't have any more questions. I'll give it another second to see if anything else pops up. But in the meantime, I just want to thank everybody who was on the call today. You can feel our excitement around this. You can certainly feel Shawn's excitement around this. So let us know how we can be of help. Our illustration team has been trained and understands how to illustrate the product. We've got the software and we are open for business. So if there's anything we can do to help you, please let us know. And again, thank you so much to everybody for attending this webinar.
Thank you, Shawn.
Okay.
Thank you. Thank you,
all.
everybody.
Appreciate it. Bye-bye.
Bye-bye.
Bye.